Today's global financial story is not being written by headlines. It is being written by hesitation. Markets are moving, but without confidence. Investors are active, but not aggressive. Governments are speaking, but carefully. This hesitation tells us more than any breaking news alert. It tells us the world economy is standing at a crossroads. For years, growth was driven by confidence. Confidence in cheap money. Confidence in endless expansion. Confidence that problems could always be delayed. That confidence is fading. Not suddenly, but steadily. Right now, decision makers are rethinking everything. Businesses are asking new questions. Not how fast can we grow, but how long can we stay strong? Consumers are asking new questions. Not what can I buy next, but what should I protect? And investors are asking the most important question of all. What does safety look like now? Interest rates remain at the center of this shift. Higher rates have quietly changed the rules of the financial game. Risk is no longer rewarded easily. Debt is no longer invisible. Mistakes are no longer forgiven quickly. This has slowed momentum across the global economy, not into collapse, but into caution. Housing markets reflect this clearly. Prices hesitate. Buyers wait. Sellers adjust expectations. This does not signal failure. It signals reality. Reality has returned to pricing. The same pattern appears in business investment. Companies delay large projects. Capital spending slows. Cash preservation becomes a priority. Again, this is not fear. This is discipline returning to the system. Banks, watching all of this closely, are adapting. They are not pulling back completely. They are becoming selective. Credit is still available, but only for strength, not speculation.
This filtering process is uncomfortable, but necessary. Every strong financial system goes through it. Inflation, even as it stabilizes, continues to influence behavior. People trust prices less than before. They trust forecasts less than before. They trust systems less than before. Trust, once broken, takes time to rebuild. This affects spending, investing, and planning. As a result, growth becomes uneven. Some regions perform better. Some sectors struggle. Some currencies strengthen while others weaken. This unevenness creates noise in markets, but inside the noise, a pattern is forming. Money is moving toward stability, toward essential industries, toward long-term value, toward resilience. Speculation is losing its dominance, and when speculation fades, fundamentals return. Global politics add another layer of complexity. Trade relationships are being reassessed, supply chains are being redesigned. Economic alliances are shifting. These changes are slow, but their impact is deep. They affect energy prices, food costs, manufacturing decisions. Nothing moves alone anymore. The global economy is too connected for isolation. This interconnectedness means small shocks can travel far. That is why markets react cautiously even to minor news. Not because they are weak, but because they are aware. Awareness is the defining characteristic of today's financial environment. This is not a time of blind optimism. It is not a time of despair. It is a time of observation, watching signals, measuring risks, preparing for multiple outcomes. Long-term thinkers understand this phase. They know that wealth is not created by chasing excitement. It is created by surviving uncertainty. This is the stage where patience becomes power, where emotional decisions fail, where disciplined strategies succeed. Economic history repeats one lesson again and again. The most important moves happen quietly, before the crowd notices. By the time confidence fully returns, positioning is already complete. Today's financial world is building the foundation for the next cycle. Slowly, carefully,